After years of speculation and delays, the launch that literally thousands of people have been waiting for is finally here. Trading 212 SIPP is now available for all customers, new and old, and could well be a total game changer for pension savings in the UK. So in this video, we're going to be answering all of your questions. Is it as cheap as their other offerings? There's quite a bit of confusion around this. What are the catches? How does it compare to other leading options? Can they be trusted with your retirement savings? And why has it taken them so long to pull the trigger? We've also seen plenty of rumours floating around the internet that we'll also be setting straight, and there are some important niche things that you do need to be aware of. Before we get into the details, a quick reminder on how SIPPs actually work. The biggest benefit compared to other tax-efficient accounts like an ISA is tax relief. For every £80 you pay into your pension, the government adds an extra £20 on top, effectively acting as a 25% bonus. Then higher and additional rate taxpayers can claim even more. The catch, of course, is that you can't withdraw your funds until you're 55. And this is rising to 57 in 2028, and then, well, who knows what it will be increased to in the future. You can open as many SIPPs as you want, so if you already have another SIPP with a different provider, you could still open one with Trading 212 if you wanted to. But let's move on to what for many people is one of the biggest considerations when opening a SIPP, and that is fees. If you're already a Trading 212 user, you'll know that they don't charge any account fees or trading commissions, and that setup is exactly the same inside of their SIPP. So, for example, if you held an ETF portfolio of £500,000, all you'd be paying are fund management fees for the funds that you've chosen, which is a cost that you'd pay anywhere and is totally separate from anything that Trading 212 charges you. Compare that to other popular options. On the same £500,000 ETF SIPP portfolio, you'd be paying at least £120 a year with AJ Bell, £150 with Hargreaves Lansdown, and £375 with Vanguard. That's a saving that's pretty hard to argue with, and puts them up there with the likes of InvestEngine, Freetrade, and Prosper in terms of just how cheap and accessible their SIPP offering is. Their FX fee is also the lowest of any SIPP provider on the market at the time of recording, and is much lower than Freetrade's 0.99% on their free tier, which is their closest comparable competitor. Trading 212 also has one of the best welcome bonuses available to new customers of up to £100 in free fractional shares. I'll include our affiliate link in the description below, and I'll also link to our full offers page in case you'd prefer to make use of a bonus offer elsewhere, but please remember that your capital is always at risk when investing. But now let's take a look at what you can actually invest in inside of a Trading 212 SIPP. Well, mostly everything that you can buy inside of their ISA or trading account, you can purchase inside their SIPP. Mainly a huge selection of over 13,000 shares and ETFs at the time of recording. But that does mean that, just like with their ISA and their trading account, you won't be able to invest into things like traditional index funds, sometimes called mutual funds, and you won't be able to invest into bonds and gilts outside of bond or gilt ETFs. If these are assets that you wanted to invest into specifically, then the cheapest provider to offer all of them inside of a SIPP is Freetrade, so I'll include an affiliate link to those down below as well. Anyone who's used Trading 212 before will know their Pies feature, which lets you build a portfolio of stocks or ETFs in custom weightings, then invest across the whole thing in one go. And when you open Trading 212 SIPP for the very first time, you'll notice that you'll be offered a default pie as a sort of starter pension portfolio. Offering a default fund is something that most pension providers do, and is meant to be like a one-size-fits-all option, not too adventurous, not too risky. For this, Trading 212 have selected their Vanguard Global Pie from their Model Pie range, which is a globally diversified portfolio built from 6 different Vanguard equity and bond ETFs. There are 4 variants of this, ranging from conservative to aggressive. When you click into the pie, by default it will show you the moderate version, which contains a 50-50 split between bonds and equities, while the most aggressive option is 90% equities and 10% bonds. This isn't the worst option for someone looking to get started with their pension, and the global diversification plus bond component helps to reduce the risk, but just be aware that this might be too risk averse for some people, as there's no option of a 100% equities portfolio. But you do still have the option to use one of their other, more thematic model pies, create your own pie built from your own funds, select a pie built by other users from the social pies section, or just not bother using pies at all. There are, of course, plenty more features like this you'll also want to get to grips with if you're using the platform for the first time, so I'll leave a link in the description to our beginner Trading 212 tutorial which will walk you through literally everything you need to know step by step. This was created before Trading 212 launched their SIPP, but because the SIPP uses the same interface and tools as the rest of the platform, it'll still tell you everything you need to know. So far, so simple. But let's address a few of the questions that we mentioned earlier, and the main concerns that some of you might have. Trading 212 has been promising a SIPP since 2020. Then they assured us it was coming in 2021, and then in 2025 they were reportedly blocked from launching it by the FCA. And even after opening access up, they had to do a slow rollout starting with existing customers. So what's with all of the holdups? The short answer is that offering a pension product is a lot more complicated and costly than offering an ISA or a general investment account, and getting the right infrastructure in place, along with the green light from the FCA, can and did take ages. Part of that process involved finding a third-party provider to handle a lot of the complex stuff, like processing tax relief, keeping detailed records that need to last decades, and making sure everything's compliant with pension-specific regulation. And when you open a SIPP with Trading 212, you'll see that they're launching it in partnership with a company called Platform One, because that's who's handling all of this stuff for them. This is a very common setup with newer fintech platforms. Freetrade also uses Platform One as a SIPP administrator, while InvestEngine uses a different company called Quay Investment Services. Really hope I've pronounced that right. But it's here that we need to bust one myth that we've seen floating around the internet. For reasons that we're not quite clear on, it was rumoured that Trading 212's SIPP administrator was actually a company called Gaudi. However, in reality, Gaudi sold its pension business to Platform One back in 2023, meaning Platform One then acquired all of its SIPP assets. But why am I telling you this? Well, because this has led to some people saying that Gaudi, as the apparent SIPP operator, would be charging people who opened a Trading 212 SIPP a £75 to £100 annual fee. While this is how it works for some platforms, we're happy to be able to tell you that this is definitely not the case with Trading 212's SIPP. They've confirmed directly to us that no fee like this will apply, so you'll be paying no more to hold a pension with Trading 212 than you would with any of their other accounts. But it's partly this setup, and partly the long delay, that has made some investors worry about whether they can actually trust Trading 212 with their pension savings. For full clarity, using a SIPP administrator also doesn't impact how safe your money is. In the UK, pensions are protected through strict ring-fencing of assets under what's known as the FCA's CAS rules, and these are regulations that force firms to keep your money and investments completely separate from their own. Platform One also has to keep a chunk of its own money set aside, specifically as a safety net in case anything goes wrong on their end. And if either platform did get into trouble, FSCS regulation still protects your pension up to £85,000. In short, your pension savings are as safe here as they are anywhere else. And you don't actually interact with Platform One yourself, you just manage everything within Trading 212. So hopefully that clears that up. If you're considering transferring an existing pension into Trading 212, then the process is pretty easy. Just head to the menu, click Portfolio Transfers, get started, then choose your old pension provider from the drop-down list. Cash transfers take 2 to 8 weeks, while stock transfers, or in-specie transfers if we're calling them by their full legal name like they've been naughty, can take up to 4 to 12 weeks, though a lot of this will depend on how speedy the provider you're transferring from is. You also won't be charged anything to transfer in, but your existing provider might charge you for transferring out, so be sure to check that before you commit. Now, when it comes to how you can contribute and how you can access your pension in later life, there are a couple of big drawbacks that are worth mentioning. The first is that Trading 212 SIPP doesn't currently allow employer or director contributions. That means if you have a very generous employer that's willing to pay into your SIPP instead of their own workplace pension scheme, or you want to be able to contribute on behalf of your own limited company, then neither of these options will be available to you. Secondly, when it comes to withdrawing your money, your options with Trading 212 will be more limited compared to some other providers. Flexi Access Drawdown is not supported. meaning you can't take your 25% tax-free portion in one go while leaving the rest invested to withdraw as potentially taxable income. Instead, your only option is UFPLS, or Uncrystallized Funds Pension Lump Sum, which means every portion you take would be 25% tax-free and 75% taxable. While this isn't necessarily a bad thing, and can even often be a lot more tax efficient, it might feel restrictive to some, especially if you know you're going to want that 25% tax-free lump sum. However, one workaround is to simply transfer to another provider who does support your preferred options as you approach pension age. But Trading 212 does have an edge over rivals Freetrade here that is worth pointing out. Freetrade also only offers UFPLS for their SIPP, but they also charge a £240 fee per withdrawal. As Trading 212 uses the same pension administrator as Freetrade, there was yet again some confusion online about whether this charge also applied to Trading 212's SIPP. We did check in with them about this too, and they confirmed that no such charge will apply. So again, it's good news. To bring it all together, we think that Trading 212 SIPP is a very decent offering, especially if you're in the accumulation stage where you're not really thinking of retiring anytime soon. If your priority is keeping costs as low as possible while investing in shares and ETFs, it's hard to argue with what they're offering. The lack of account fees, dealing commissions, and low FX charges make it one of the cheapest and best value SIPPs on the market, while their platform still provides one of the best user experiences out there. The lack of flexibility around contributions and withdrawals is a bit annoying, but this probably won't bother you if you've got decades of retirement savings ahead of you. Plus, you can always switch providers if needed when the time comes. All in all, a solid 8 out of 10 and a very impressive first crack at the SIPP market from Trading 212. It won't tick every box for every investor, but if you're looking for a low-cost, simple way to build your retirement savings, it's certainly earned its place as a leading contender on the shortlist.